So the panic in the markets, the stock market is deep in the red and it's happening fast. In just days, the S&P 500 suffered its fifth straight decline, marking the worst week of the year, only a week after hitting an all-time high. I mean, these are the types of things that investors everywhere are asking, and they're asking, are we heading into a recession? This is nerve-wracking. And if somebody's watching this, I mean, I've seen my own portfolio swing quite wildly. And before we hit the panic button, let's break down what's really happening, why this might not be a full blown recession, at least not yet. And more importantly, we'll see this current chaos start to unravel, and opportunities for savvy investors most likely will come. There is urgency and clarity that you need in these markets. So first, let's address, why are stocks selling off? We see Tesla is down to $211. And there's one word, it is tariffs. President Trump's trade war escalations have spooked the markets. I think there's 100% tariff on Tesla from Canada as a response. Chinese goods, China's hitting retaliation. It's not just there, but the world's largest economies. It's going to impact them. It's going to start some recession fears. Wall Street's now worried that the trade war could slow down economic growth worldwide or could tip us into global recessions if things get worse. Now, a lot of people, investors, say we're in a recession right now. Look at this sell-off. We're starting to see stocks dump, and we're not even there. But here's the thing: if we saw money just pour into treasury bonds, or we start to see gold skyrocket, that would show us more that we're in a recession. But we haven't seen that yet. So we did see treasury yields plunge as demand surges for safe assets. But Wall Street's basically screaming, hey, I'm really scared, and this is what's happening. A lot of these stocks are red. And now we're kind of betting on the Federal Reserve to cut interest rates to soften the blow from the trade war. So when you see markets kind of hitting these records, tariffs and trade tensions are escalating. I think right now this market sell-off is just due to tariffs. I don't think the US is really feeling the pain of a worldwide, downturn. This is something that's being felt in Europe. You can see it's not just the US, it's global. It's not just the US market. One market strategist that I was reading earlier said the markets appear to agree the tariffs are not good for most risk assets. Equities around the globe tend to suffer. Now, investors know that higher tariffs can raise the costs for businesses and consumers, and that's going to squeeze the profits and the spending. That's part of why everybody's selling. And there's even worry that tariffs could spark a bit of stagflation. Not that we're not already in stagflation, where we got inflation over here, assets prices still going up. But I just want to point out that it's more of a slowdown. And if this is just because of tariffs, Trump could end this all and just lift tariffs. Or if we get through this trade war, then these fears will go away and we could see a huge rebound from the market. So you might have some recession fears as a result of some of this tariff stuff, but the reality is, in a recession, right? If we're wondering if we're in one, the short answer right now is not officially, okay? A recession isn't just a market drop, it's defined by a significant decline in economic activity. So throughout the whole US, we started to see a little bit of shrinking GDP, but we need to see it for multiple quarters. We need to see surging unemployment, businesses closing. That's the works. And yeah, growth has slowed in some of the markets, but we haven't seen an actual contraction in overall economic activity in the US yet. Jobs are still being added. They're slow. Consumers are still spending money, at least for now. And there's no official recession call that has been made. So we're experiencing right now, it's a fear of a recession, but it's not an actual recession. It's an important difference to look at. A lot of the turmoil is driven by psychology right now and anticipation. And one major alarm bell that rang was the inverted yield curve. That's when the short term treasury yields rise above long term yields. And that's just a classic recession predictor. Indeed, US yield curve did invert recently, and historically, such inversions have preceded recessions in the US, especially since the 1950s. On average, when long term rates drop below short term rates, a recession has allowed a 6 to 22 months later in many cases. But everybody's freaking out about that. And of course, that's kind of spooky because of the track record. But here's the key with what we're looking at in the markets: it doesn't guarantee immediate recession. Some experts argue that that yield curve might not be as foolproof as a predictor as it once was. Today's economy has a lot more factors, heavy Federal Reserve intervention. So if they cut interest rates, that's going to definitely impact us. There's different inflation dynamics and how money is earned. And then with the advent of AI, that's going to change things too. So we don't have proof of a recession happening right now, but we are in a slowdown or a mid-cycle hiccup, and we just haven't tipped into a recession just yet. So take a deep breath. Let's see what the data says over the next few weeks, and before we get into the recession talk, there's a lot of evidence that could point that way. And of course, the tariffs are one thing, but again, if tariffs lift or we get through this, and we carefully watch, we could see a big rebound. So recessions usually involve things like spiking unemployment, falling incomes, pullback in consumer spending, but we haven't seen that just yet. Still seeing consumer spending pretty strong, and the economy's still growing. So that's why a lot of analysts are saying it's not a full-blown recession. So we should still prepare. We should still be vigilant. I mean, you could see a lot of the red here, and there's some panic, but I wouldn't say that it's full like 2008 status or anything like that. And how are we going to tell? What are we looking for? It's going to tell us whether we're going into a full-blown recession versus just a short-term market crash. Well, there's some key indicators to watch in the coming weeks. Gold prices, again, we'll be watching very closely. If gold, it's a classic safety play. I don't think we saw any big spikes on gold recently. If we take a look at gold, we take a look at Gold Trust here. It was up just 0.02%. So gold thrives on uncertainty. We see it, go up a little bit here. Tariffs are the main thing right now that are bringing the uncertainty. And in short, if we see gold start to really spike up, that's rising fears and prices as they keep surging with gold. That could, definitely create some more anxiety in the markets. But did pull back. We saw gold pull back a little bit. And for now, the risk sentiment, we're going to watch these prices of gold. That's usually where investor money goes if we're in a full-blown recession. And, treasury yield and the yield curve, recession signals that we watch, we'll be taking a look there, the 10-year treasury. I think when it comes down to tech stocks, when we look at some of the markets, you saw tech AI was down a little bit. Some of the companies that sank the most were definitely Tesla. We saw the growth basically wipe out most of the gains we saw post-election on Tesla. Some of the companies that didn't quite move as much as I thought, but were holding kind of strong. Cooler dropped 5%, not doing as bad as I thought. CTM was a stock that we're in and trading today, and I think it's still holding that $1.02 range. We're still in it there. There's going to be there's going to be a vision that we're going to want to look for here and see if some of this sell-off deepens and some of the anxiety grows louder. Right now, the markets, it's starting, I believe, to regain some confidence because, and I'll tell you why, when you look at the bond market, there is some shouting concern, but again, it's almost 90% looking like it's the tariffs. It's not anything else. The tariffs seem to be the main concern. So why I say that is there's one thing that could end all of that very quickly. And if we see tariffs either raise, which might not happen, but one change in tariffs or a deal that gets made will influence all of the market, and there would be a positive reversal sign. So we're going to be watching gold for sure. We'll be watching the rest of the markets. This is a time when you can make money in inverts. So we'll be checking out some inverse stocks. We'll even like one of the stocks that was like crazy swings today, TSLS. So TSLS was up 5%. NVDQ, so inverse of NVIDIA. We're going to be watching here in some of these stocks that are inverses as well to potentially trade in the market open. Now, one more thing I want to reinforce about this not being a full-blown recession. We touched on some reasons, but I think it's really important to repeat these to you guys, which is there's no broad economic contraction. The economy, yeah, it's slowing, but it's not anything dramatic. We haven't seen consecutive quarters of GDP decline, and I would imagine that with some of the sell-offs we've seen in the market, it hasn't been this significant decline in economic activity. It's just been mainly looking at the tariffs. So we'll see how that plays a role in the next few weeks. And I think we are still in decent shape as the market and where we are right now. And we'll just have to see what takes place over the next few weeks again. And we'll watch closely. If you start to see job losses mounting, consumer spending falls off a cliff, which isn't happening yet at scale, then yeah, we're going to see definitely federal bank support. The Federal Reserve, they're already probably in action mode with the market's reaction. They may cut interest rates even more. And if we see more interest rate cuts, that's going to some of the shock absorbers for the sell-offs, and will most likely see some increase in spending. If, for example, tariffs get lifted and then we just see a tax cut of some sort, that would be a positive force that would drive a lot of the markets up. And again, what does Warren Buffett say? Buy when there's blood in the streets, or when everybody gets greedy, that's when you sell. When there's fear, that's when you buy. That's something to consider as well when you see some of the sell-offs in the market. But man, definitely see Tesla trying to hold that $212 or $220 support, and then it just sold off even more down to $212 today. So a lot of pain with the tariffs. We'll also see there's a lot of things that look good. For example, Apple, one of the things I like is that $500 billion moving their facilities and teams into US, Michigan, Texas, Arizona. This is something that will most likely make the US more resilient, is building factories even more in the US. And that puts us into, it's like everything is a whole body. It's not just tariffs, but there's also like, are we having good factory growth, manufacturing? Are we seeing some of the spending cut down in the government? Are we maybe working out the taxes for a more favorable average household support? And are we supported by strong job markets? And if that's the case, and some of those things start to good, Americans can keep their jobs, their paychecks, and they're likely to keep some economic growth happening here over the next few years. So again, we'll watch closely. Thank you guys so much for watching. And just in short, with everything we've gone over, we have some warning signs, but not a full recession checklist just yet. This market sell-off is real and it's painful, but it's largely driven by fear of what could happen rather than what has happened in the economy so far. So it's a critical distinction that can mean this downturn is temporary if the right moves are made to restore confidence. So it could also mean that that's a major buying opportunity if the tariffs lift. Now, that's kind of the silver lining, is that all this doom and gloom could mean big opportunity. Big market corrections mean potentially big rebounds. And especially if the catalyst for fear is removed, if the tariffs, or we reach something with the trade war and President Trump and China's leadership strike a deal, or even just call a truce on tariffs. If those tariffs get lifted or scaled back, it would be a game changer for the market, and all that recession chatter could quickly cool off as more businesses can breathe and have a sign of relief. So we've already seen some of a glimpse of this. Whenever there's a hint of trade peace or tariff delays, stocks have rallied super hard. Recently, a temporary suspension of some tariffs was enough to send global markets to record highs back a few weeks ago. And so moving those trade barriers allows companies to operate with less costs and uncertainty, which would be good for the stock prices. So we'll see how that plays out. Again, right now, many growth assets like tech stocks, industrials, and emerging markets, they have been beaten down in this sell-off, but there's most likely going to be a lot of opportunities in the near future, and there's ways to play some of the market crashes in a way that will make you money. If you guys want to know how to get quality growth and take advantage of some of these opportunities when stocks are down, I would encourage you to check out the second link in the description. That's StockMate. We go live. We traded this morning at market open. If you'd like to watch us trade, take some of the emotions out of it, capitalize on some of the moves in the market, and watch me trade live each day at market open, surround yourself with other traders and investors, and get access to a lesson library. It's the second link in the description. We have a special sale there, and it's not going to get too much better than this. So if you guys want to take a look and join us tomorrow, that's the place. Again, it's the second link down below. If I earned your thumbs up, hit the like button. Do consider subscribing, and I'll see you guys in the next video. Take care.